Well, the decade gone by was essentially a great decade for equities. The standout feature was central bank policy action, a decline in interest rates and abundant liquidity. The net impact was that interest rates in last 10 years across the globe, they came out, and let's look at that, what has been the real decline in interest rates. Because interest rates always act like gravity, and if interest rates they come down, equity valuations always remain high. Just focus on US 10-year paper. You may want to ignore 1999, but between 2009 and 2019 beginning, the interest rates in America came down by 2%. The German 10-year yields are in negative now, and India also, interest rates between 2009 and 2019, they've come down marginally. Of course, we were much more sticky inflation. Equity markets responded to this kind of a scenario. Equity valuations went higher, growth made a comeback, and the US markets in a sense was the standout gainer, while other markets may just look dwarf in front of what S&P for the decade gone by has given, and Nasdaq was almost 3x for the decade gone by. So what is in store for this decade? How should one value equities and assets in this decade? If interest rates are low, are we in this kind of a new environment? Now to discuss that, to understand that, to talk about valuations, because ultimately markets are all about valuations, I have with me someone who is the foremost authority of valuing companies and businesses, Professor Aswath Damodaran. Professor, Happy New Year. Thank you for joining us. So good to connect back with you. Hope you're enjoying the winters in US this year. My first question to you, Professor, is what I just talked about in the opening graphic. We've just ended the decade, and the decade gone by has been extremely good for equities as an asset class, and US markets have given outlier returns. Emerging markets have also not done bad. So what is your sense for this decade? Equity as an asset class, will it continue to outperform other assets?
There are a couple of things that are interesting, because looking back, it's been an amazing decade. But if you look at it relative to the previous 8 decades in the US, it actually falls right in the middle. It's actually it's closer to the median than it is to the highest or the lowest. So that surprises people, because they look back and this must have been the best decade ever. It's actually the 4th best decade over the last 9. So the first thing is, over the decade, don't get me wrong, it was a very good decade for stocks, but it was not so good that you look back and said, it's never happened before. The second is, it is true that after a decade like the last one, or a year like last year, the US stocks are up 31% if you include dividends, that you're less likely to see a really good year than you are likely to see a bad year. It's just the nature of markets. What markets give, markets often take away. It doesn't mean next year is going to be a bad year. It means that the odds of it being another 15, 20, 25% year are very low. It's happened before, but they're lower than they would have been if last year had not been that good a year. But it is true, it's been a great decade for stocks, but looking forward, I wouldn't expect things to continue the way they are, simply because markets don't operate that way.
So, Professor, you always mention the importance of interest rates. Interest rates, they act like gravity, which is if interest rates they go higher, valuations will always come lower. Interest rates cannot go down lower than this. In Europe, they are in negative territory now. So one works with an assumption that interest rates somewhere in the decade will move higher. What will that do to the underlying valuations of equities?
You know what, I've been hearing that for the last 8 years, right? Interest rates are low, they're more likely to go up than go down. I don't disagree with it, but after 8 years, you've got to stop and ask, maybe this is not an aberration, because for the last decade, at least in developed markets, people have been waiting for the other shoe to drop. They look at rates and say, there's no way rates can stay this low. They have to go back. But after about 8 or 9 years of the same phenomenon playing out, and blaming the central banks every time this happens, maybe it's time you stop and ask the question, maybe this is the way it's going to be. I think we live in a world, and this is the world that we live in for a long time, of low rates and high risk premiums. It's a different world than the world we saw before the 2008 crisis, but I think it reflects the reality of markets now. Low rates are here to stay. Having said that, rates, if they go up, Whether they affect stocks badly will depend on why they go up. And let me explain. Rates can go up because the economy is doing much more strongly than expected. That's one reason. If that's the reason rates go up, it's a mixed effect because rates going up makes stocks, they're less attractive, but a stronger economy helps your earnings and cash flows as well. The net effect could very well be positive. So you could see rates go up and stock prices go up. If rates go up because inflation goes up, that's a much more negative scenario. So I think when you think about rates going up, you got to stop and ask the question, why are rates going up? Because the reason might drive.
Question, which is that globally and also in India, there is a big migration towards mega caps, and the reason why, Professor, that is happening is because in US towards companies are growing. In India, large corporates are growing. So do you think this migration towards mega cap, which started towards the middle of last decade, is here to stay for another 8-10 years?
In some sectors, that's going to happen simply because of the nature of technology. Winner-take-all businesses are becoming more the rule than the exception. You look at online advertising. Hey, Facebook and Google are not only winning, they're winning at bigger and bigger rates every year because if you want to advertise, you want to go where the people are. And guess what? Where they are? They're on Facebook and Google. So I think as long as that phenomenon kicks in a sector, you're going to see big companies get bigger. And I don't think it applies across all sectors. It's not like big steel companies are getting bigger. It's the phenomenon that you see play out in some businesses because it's becoming more of a winner-take-all kind of business. And that's becoming more common. And maybe we need to stop and ask a question about antitrust laws and how they're written. Because antitrust laws, as they were written, were designed to protect the consumer. Unfortunately, when you think about using them against the Googles and the Facebooks of the world, these guys are not charging too high a price. They're charging too low a price. No consumer is complaining about Facebook saying, hey, they're charging me nothing for being on social media. That's wrong. So it's a very different world we live in. And I'm not sure the antitrust laws that were written 100 years ago for manufacturing companies can even be applied against the businesses of today.
Right. Let's talk about the important event, Professor. US presidential elections in the second half of 2020. The current Republican administration has changed the narrative of the world because of trade war. What should one expect from US presidential elections? I'm not talking about, I'm not telling you to predict the winner here, but what do you think will be the economic importance of this year's US presidential election?
I think it depends on whether you think, because what's happened in the US, I think, is technology companies are hated by both sides of the spectrum. It's not like they're hated by the Republicans, they're hated by the Democrats. Both sides of the spectrum have problems with technology companies. I think they're all wrestling with how do we deal with the fact that these companies are becoming so big and so powerful. So I think no matter who wins the 2020 elections, I think change is on its way for technology companies. And I think if you're Facebook or a Google or an Amazon, you need to learn to deal with that change. Because technology companies historically in the US have not been very good at playing the political game. They haven't lobbied like, banks and oil companies. They need to start to get more active in protecting their interests because their interests are going to be under assault no matter who wins the election.
Professor, millions of your followers, they follow your blog very closely, and you've been time and again indicating, sharing your thoughts on how one should really value or assess valuations for internet companies. Internet companies or tech companies for the decade gone by selectively have emerged as multi-baggers. In this decade, what is the right methodology to value internet companies? Because given that Lyft and Uber listings have not really created phenomenal wealth, WeWork has been a disaster. I wonder what is in store for the tech/internet companies.
I think that the problem is, first, I'd like to see them valued. For the last decade, young startups and tech companies have been priced rather than valued. And for those of you who might not know the divergence, pricing, you look at what other people are paying for similar companies based on users or subscribers or revenues, and you attach a pricing. I would like to see more valuation. Questions asked about business models. Don't just tell me you have millions of users. Tell me, so if you're Oyo, I'm impressed that you have, thousands and thousands of hotels and you've got tens of millions of people who stay at them. But I'd like to know what your business model is to make money. That was the missing ingredient in this last decade. I hope to see good sense prevail more in the coming decade, but I'm not hopeful.
Professor, this could be a coincidence, but we've seen that with each decade, new methodology emerges. There are traditional parameters, there are new parameters on which how markets they value and assess companies. So which sector, plan or methodology of valuation will be rewarded in the coming decade or in the current decade? And to your mind, which would be some of the high growth companies for this decade?
I think markets will reward you for taking the right risks. If you take risk indiscriminately, you're going to be destroyed in this market. You have to kind of figure out which risks are worth taking, because if you take no risk, you're going to make no return in this world. So for those people who say, I want complete safety, you're going to be making 2%, 3% returns. You're going to complain about it, but there's nothing you can do about it. You have to take risk, but you have to take it in a sensible way. If you don't feel comfortable picking the right companies, my suggestion is buy index funds, spread your bets, diversify, because that's a much safer strategy than going out chasing stocks that did well last year or the year before, because that's not a strategy that's going to make you money in this market.
So, Professor, again for the decade gone by, we've seen emergence of ETFs. ETFs as a category now have a very large role to play in the way how investors would be allocating capital. Most of the active fund managers have managed to underperform their benchmark indices. Do you think active investing is going to be dead and passive investing, which has made a comeback, is here to stay?
Absolutely. And the reason is it was long overdue. Active investing, for the most part, is lazy and inefficient. It's always been lazy and inefficient. Most portfolio managers who are charging you 1.5% to 2% of your money to manage it were buying low PE stocks blindly and hoping that they would go up. Hey, guess what? I can create an ETF of low PE stocks and charge you nothing. I think active investing is getting exactly what it deserves. I will shed no tears for active portfolio managers who get wiped out by ETFs and index funds, because many of them deserve to be wiped out. I think active investing will stay, but it'll be much smaller, more focused, and it'll consist of portfolio managers who actually bring something to the table. So if you're an active money manager, bring something to the table. Don't screen for stocks and tell me you're an active money manager, because an ETF can do that a lot more efficiently than you can and at a lot lower cost.
Professor, a concern which some of the classic investors are raising in India is that India has got great companies, but valuations and PE multiples are ridiculous. Good companies in India on an average are trading at PE multiples which are above 40 times. Underlying growth is strong, enviable if I look at global companies, because Indian good companies are still growing at 10 to 15%. So who will get it right, who will get it wrong? Do you think the purists who say that watch these stocks will not give good returns because of elevated levels, or the new HNI crowd which believes in buying these good companies irrespective of the valuation?
Well, this is what I mean by lazy active investing, right? I know why these guys have jobs, to be quite honest. If that's your definition of investing, is to pick a company with a big name and pay a high PE and hope and pray that the momentum will carry you forward, why am I paying you money to be an active money manager? I think that's a very lazy way of investing. I think momentum is a strong force. You can ride it, you can make money until it stops. I do think, though, that increasingly around the world, what I've been noticing is a disconnect between stocks and domestic economies. And the reason is, as we globalize, what we're discovering is companies' success is driven not so much by what the domestic economy is doing, but by what the global economy is doing. Even in the US, the link between US stock prices and the US economy has dropped off dramatically in the last 30 years. So I think we can have two discussions. One is about where the Indian economy is going, and the other about where Indian markets are going, and actually come to very different conclusions on those two debates, because the two are starting to de-link, and it's not just India, it's happening across the world.
Let me ask you a difficult one now, Professor. In India, the headlines, at least the economic headlines, are not great. The macro is deteriorating. Benchmark indices are at an all-time high. This kind of an so-called divergence between headlines and price action is unlikely to continue. So where do you think the convergence will happen? Will the economy improve or will markets come down?
But if your earnings are increasingly global, you can get a disconnect between your earnings numbers and what the economy is doing. I mean, look at the last 10 years. For the most of those 10 years, the U.S. economy was not growing very fast, but U.S. companies were growing earnings at double-digit levels. Why? Because we're finding growth elsewhere in the world. So I think that's one of the factors causing a delinking. It is absolutely true that if the Indian economy stays in the doldrums for the next 5 years, then Indian companies are going to be in serious trouble. I mean, hopefully this too shall pass. So markets look long-term. So often we're in the midst of an economic slowdown. Markets are seeing when the slowdown is going to end. So maybe markets are a little more optimistic about the future of the economy than economists are. And guess what? If you have to pick between what economists forecast for the economy and what markets forecast for the economy, I'll take markets every single day.
Professor, some would also argue that in India the corporate governance standards have been compromised, and corporate governance standards have been compromised by some of the holier-than-thou corporate management. So I'm not getting into specifics here, but in general, do you suddenly worry about corporate governance standards in India, which up until now were very high, and India was getting a premium because of that?
You know what? Corporate governance is one of those interesting phenomena where people think that if you pass strong corporate governance laws, you get good corporate governance. I liken it to democracies. Let's say tomorrow you passed a law that said only good governments will be allowed in a democracy. Passing the law is easy. Enforcing the law is impossible because it depends on the voters you have in the democracy. If you vote for good governments, you get them. If you vote for bad governments, you get them. Same thing is true about corporate governance. If we want good corporate governance, laws are not going to get us there. You know what's going to get us there? You and I as stockholders have to stand up for our rights. You and I as stockholders have to say, look, I am not willing to be a second-class citizen in a company where I supply capital to you as an investor and you then ask me to go away because you're going to run the company as a family group running the company. If we put our money behind our words, good corporate governance is going to be part of the process. But it's going to take a long time. India is still full of even companies that claim to be not family group companies that are run by founders and promoters who want to use markets to raise capital, but they're not interested in getting any feedback from markets about how to run their companies. That'll take a long time to change.
Professor, you've gone on record and have said that Indian technology companies are like old US manufacturing companies. They are mature businesses, and I think it's visible. Big tech in India is struggling to grow even at 10%. So what does future in store for some of these companies which up until now were regarded great for their ability to generate cash?
I think you're starting to see them try to recreate themselves, but it's very difficult for companies that used to make money in one way, make money in a very different way. I think that they're going to try. One or two of them might make it. I won't name names, but they're all trying to kind of restructure themselves. But this is a very different business. Even in the US, the software business is slowing down. So when you think about technology companies in the US that are succeeding, they tend to be companies, as you describe them, as user-based companies or platform companies. That's a very different mindset, and you're starting to see some young Indian startups go down that space. So who knows, 10 years from now, your big Indian tech companies might not be the Infosys or the TCSs. It might be one of these new companies that's come out of pretty much nowhere. Because remember, 10 years ago, Facebook was nowhere. Today, it's one of the largest companies in the world. So these companies can come out of nowhere. I describe young tech companies in general as living in dog years. They grow fast. they don't stay at the top very long, then they decline fast. And it's the nature of tech companies. So you never know what's on the horizon. And India is full of very bright tech people, so I wouldn't put it, I wouldn't be surprised. In fact, I would be surprised if you didn't see some new names as tech names 10 years from now that we don't even know about now.
Professor, I may sound slightly repetitive with this one, but just pardon me on that. What would you say would be the high growth sector for India and high growth sector for global economy for this decade? Because every decade will give you something which markets are not anticipating. It's only in the middle of the decade we realize that, oh, this turned out to be the high growth sector. So what do you think is going to be the genie in the bottle, so to speak?
I think green energy comes to mind because in a sense, we all accept around the world, no matter what you think about global warming, that the day of fossil fuel economies is coming to a close, slowly, but it's coming to a close. But we still need energy. We have all these appliances that run on energy. So green energies has to mature. You can't be subsidized for the rest of your life. So you're going to see green energy as a space expand. I think you're also going to see more, on-demand services. Things that we used to go to a store to or to a mall to do. No, I'm not even talking about online retailing, but on-demand services that you need as a consumer start to be delivered to you because we now have the technology to do it. Increasingly, you're going to see things done in physical spaces move online, for better or worse. So you're going to see businesses in almost every sector kind of try to disrupt the way things are done. And I don't think these businesses are going to be the existing companies. They're going to be new companies. Electric cars as part of the green energy space, you're going to see it, I think, expand as a business, mature as a business. I don't know who the winners will be. I own stock in Tesla now. I bought it 6 months ago. I don't know whether Tesla will be one of the great winners, but this is going to be a space where you're going to see a fight play out. And if you're an Indian automobile company, you better be active in this space. You're going to be left behind very quickly because disruption is coming to the space as well.
So Professor, given your view on technology and the way how the dynamics of the world is going to move, which corporate group or which corporate groups in India could be the outsized gainers? Will it be the Tatas? Will it be the Reliance? Or do you think something new disruptive is going to emerge from India Inc. in the 20s?
You know what? It's a crapshoot. I think on any given day you can look at the Reliances. They're going to be the winners. I think this is going to be a place where every corporate group. It's not going to be a question of skill. It's going to be a question of luck that's going to determine who the winners and losers are. I know that's not what we're supposed to have. We're supposed to have skill and savvy management. But sometimes being in the right place at the right time is vastly underestimated. So I'm going to hold my fire. I think I am happy with how the Tata Group has kind of evolved since their corporate governance struggles. The question is, can they be aggressive enough in the space? Because this is a space that requires that you do things where you don't see the results right away. Reliance with Jio has clearly made that leap into a space where I think it's not doing it because it wants to sell telecom service. It wants a platform to sell out the stuff. They've set up for that. Let's see if it actually works out. So I would keep my eyes on how much a family group is willing to experiment in these spaces and be willing to lose money. Because I think that's what's historically held them back is that they need to make money to show that something pays off. And you have to be willing to kind of lose money for a long period. I said, you almost have to model yourself on what Amazon did, which is you enter, you're patient, you lose money, but eventually you win out. And family groups have the capital to survive these fights. So they have an advantage that they should put to good use.
So Professor, now that you mentioned that clean energy and clean energy would be the big theme for the 20s, how exactly do you think markets are likely to value and revalue some of the old economy businesses, steel, thermal coal companies? The world would still need steel, cement and thermal energy. If the world is migrating towards environmental conscious companies, I wonder what does future in store for some of these businesses?
I think that, steel's been in a long term. I mean, the cement, one of the things about cement is you got to be local. It's so expensive to transport it. So one of the advantages historically of being a cement company is you don't have to worry about global competition because it's not like you can bring cement across thousands of miles. But you're very dependent on the construction business locally to survive. I think the worry that if you're a cement company is that technology will come up with an alternative to traditional cement. It's not happened yet, but it'll happen. But steel has been in a long-term downturn. And I think with steel, I would point to a culprit that I point to all the time, which is China. And the reason I think of it as a culprit is for a decade, from 2001 through 2014, China skewed all of these markets, right? Because the construction, the infrastructure, the immense amounts that China was using of these resources. You can think about oil and steel and pretty much every construction material pushed up the prices of these commodities to levels way above what they used to be pre-2001. I think what's happened in the last 5 or 6 years is a return to normality, because once you took that tremendous demand from China out of the equation, it kind of pushed the demand back to what used to be more conventional demand. So some of this is markets trying to adjust to the fact that there is no China coming back. There is no additional infrastructure boost you're going to get in the next 10 years. So I think that they might be undervalued, but they might be one of those, I mean, when you invest in these stocks, you have to invest for the cash flows. You can't expect the price to kind of pop back up because there's an air of pessimism about the future that might keep prices down, but you can still collect the cash flows.